Welcome back to Iraqi Dinar Hub, where we continue to monitor the evolving discussions surrounding Iraq's currency and its broader role in global finance. For more than a decade, the Iraqi dinar has remained a focal point for a committed community of currency holders across the world. This interest began in the early 2000s, after Iraq entered a period of profound transition. Many people purchased dinar with the expectation that a resource-rich nation would eventually stabilize economically and see its currency strengthen on the international stage. Throughout this long wait, the conversation has been marked by waves of speculation, with countless rumors and unverified claims circulating online. These narratives frequently left holders attempting to sift legitimate updates from pure noise. Despite the uncertainty, their core expectation never changed, believing that one day the dinar could gain meaningful recognition and liquidity worldwide. Today we are taking a closer look at emerging reports that suggest a tangible shift in how parts of the U.S. banking sector are dealing with the dinar. According to these new accounts, several major American financial institutions, including familiar names like Wells Fargo, Chase, and Bank of America, have reportedly begun accepting and processing Iraqi dinar notes at certain branch locations. These developments, as described, do not appear to be minor test programs or isolated miscommunications. Instead, the reports indicate a documented update in bank procedure, implying a renewed approach toward Iraq's currency. The potential implications of these claims are significant, both for longtime holders who have waited for any sign of progress, for the broader narrative surrounding Iraq's financial standing. Our aim is to analyze these reports carefully, exploring the internal processes said to be in place and assessing why this shift is drawing heightened attention. We will also look at what this could mean for liquidity and confidence, critical elements in the long-term trajectory of any currency. For many people, the dinar story became a symbol of hope and long-term belief in Iraq's economic future. After 2003, as Iraq undertook the enormous challenge of reconstructing its national infrastructure and governmental systems, some international observers believed the nation's natural resources and rebuilding efforts could eventually translate into a stronger currency. The idea was straightforward. Owning the currency of a country with vast oil reserves but temporary instability could become a strategic investment if stability returned. Over time, however, this practical outlook shifted into a wave of online speculation. Extremely optimistic stories began circulating, suggesting enormous overnight gains or dramatic reevaluations that lacked any connection to official financial policy. The distance between these optimistic claims and the realities within Iraq became a defining aspect of the dinar conversation. Iraq's central bank has maintained a controlled monetary policy with a pegged exchange rate, meaning rapid appreciation was never realistic in the short term. Meanwhile, domestic challenges including political turmoil, corruption issues, and heavy reliance on oil revenue continued to shape the dinar's genuine economic position far more than external speculation ever did. Still, a loyal group of dinar holders remained committed. Their dedication was often rooted in the belief that Iraq's economic revival, while slow, was unavoidable. They pointed to the country's immense natural wealth and its ongoing efforts to establish stronger relationships with international partners as evidence that patience would eventually pay off. For many in this community, the dinar grew into something symbolic, representing confidence in Iraq's eventual rise and hope that their prolonged wait might one day be vindicated by the nation's return to financial strength. Yet this enthusiasm increasingly clashed with skepticism from the established financial industry. By the early 2010s, this skepticism solidified into strict operational decisions. The majority of major U.S. banks which had once conducted limited dinar exchanges chose to withdraw entirely from handling the currency. This shift marked a pivotal setback for holders, removing the simplest route for liquidity. Banks such as Chase, Wells Fargo, and Bank of America cited multiple practical concerns that rendered dinar processing too burdensome and risky. These decisions were not arbitrary, but were driven by clear operational and regulatory concerns. Banks pointed to the elevated risk of counterfeit dinar entering the market through unregulated channels. Authenticating foreign currency is a complicated process, and ensuring that thousands of branches had trained personnel and the correct technology to verify dinar notes was impractical. Additionally, actual customer demand for dinar exchanges was extremely low when compared to major foreign currencies like euros, pounds, and yen. For large financial institutions, committing resources to a low-volume, higher-risk currency made little business sense. Compounding the issue, the U.S. Treasury did not offer any specific guidance that encouraged banks to handle dinar. Although the Treasury recognizes the dinar as a legitimate currency, it provided no special regulatory support. This reinforced the perception that the dinar functioned more as a collectible or speculative asset rather than a currency with meaningful transactional demand. As a result, dinar holders were left with few options within mainstream banking. The consequences for holders were extensive. Many who had bought their dinar from online dealers soon discovered that exchanging them through traditional U.S. banks was no longer feasible. They could not rely on local branches for service, or even accurate information. This forced holders into a scattered marketplace of private dealers and small exchange services. In this environment, they frequently encountered very wide spreads between buy and sell rates, making any transaction expensive and difficult. The currency's absence from the traditional banking system cast ongoing doubt over its legitimacy. For years, the prevailing view among financial professionals was that the dinar, at least from a U.S. holder's perspective, had become an illiquid asset with no clear path back into the formal banking system. Holders stored their notes in safes and drawers, waiting for an opportunity that never seemed to arrive. Online communities kept speculation alive, but those conversations were largely disconnected from actual financial policies. This prolonged stagnation is what makes the recent claims so noteworthy to observers. In recent months, however, a series of reports has emerged suggesting a potential shift in this long-standing U.S. banking stance toward the dinar. Some observers see these reports as early signs of a meaningful change. According to these accounts, first-hand experiences indicate that certain Wells Fargo branches in multiple states have begun accepting 5,000 denomination dinar notes. These are not being described as accidental transactions or policy misunderstandings. Instead, they appear to reflect an intentional update in internal procedures. Additional reports claim that Chase Bank has adjusted certain areas of its internal foreign currency listings to include denominations previously excluded. This suggests direction from upper-level operations rather than branch-level decisions.
Meanwhile,
Bank of America has reportedly allowed select long-standing clients who meet strict eligibility requirements to conduct dinar-related transactions. Although none of these accounts suggest a nationwide policy, the emerging pattern has caught the attention of many within the community. It is important to understand why these reports matter. They reflect what some view as a modest but notable re-engagement with a currency long considered too risky for mainstream systems. Several factors may explain the timing of this shift. Iraq has been undergoing updates to its financial infrastructure, modernizing banking procedures, and improving regulatory compliance. Enhanced note designs and better anti-counterfeiting technology could be making verification easier for U.S. banks. These improvements directly address issues that once kept financial institutions from handling the dinar. To long-time holders, even limited acceptance represents more than just a procedural update. It signals that the dinar is slowly moving out of speculative online discussions and back into formal financial channels. Even if only in early stages, this can have a meaningful psychological impact on the community. However, caution is still essential, as these changes remain limited in scope and vary heavily by location. This leads to the critical distinction that must be stressed. Acceptance does not equal revaluation. As hope grows, it is essential to separate these frequently confused ideas. Reports that certain U.S. banks may now process dinar transactions simply mean those banks are willing to handle exchanges at the current market rate. This is not an indication that Iraq has raised the value of its currency. Acceptance is strictly a matter of liquidity and access. A revaluation, on the other hand, would require an official move by the Central Bank of Iraq to change the dinar's exchange rate. That has not occurred. These new reports do not involve rate changes, only functional access. Still, increased accessibility is not insignificant. It suggests that financial institutions may have greater trust in Iraq's improving regulatory and monetary systems. Over recent years, Iraq has taken steps to modernize its central banking operations, adopt better fraud protections, and strengthen digital monitoring. These efforts reassure global institutions that the risks associated with handling dinar are slowly diminishing.